What do you make of the recent more inversion that we're seeing in the 2-10 part of the curve? I mean, you can replay conversations we've had time and time again over this story about what it says about the Fed in the short term, what it says about longer term market expectations about growth. But you also add into there that the fact that there are other curves available. The Fed maybe likes to look at other durations. What do you make of it?
I think the 2-10s curve will invert further this year. I've kind of long been in the camp that it's going to go beyond 100 basis points inversion, and that kind of goes with the idea that the Fed will continue to hike more than many people think because inflation will stay sticky and the economy will be resilient. So I think it's only when it's quite clear that the recession is hitting and that we're very clearly going to get cuts very soon, that's when the curve should start re-steepening, and that's when we'll get more worried. So I'm expecting 2-year yields to go significantly higher still. That's kind of been my long-held view. And as part of that, I think we'll get a deeper inversion because the 10-year will stay slightly more anchored.
OK, and we're going to get inflation data out from the United States next week, which is going to be the market's focus, of course.
It's massive. I mean, we hype it up every month. US CPI has become the new non-farm payrolls print. And it's fun and exciting. For the past 20 years, we've kind of ignored inflation as the big print. I mean, maybe ignored is a little bit exaggerating, but it's always been about jobs. It hasn't been a worry about kind of inflation for decades, really. And now this is the most important print in the calendar. It's a global inflation story, but it's Fed monetary policy that's still driving every other market out there. Now, the backdrop of this week is a market that for months only wanted to see a dovish signal. Since last week's jobs report and some of the Powell messaging, they've gone, oh, wait a sec, maybe we should be alert to the hawkish side. And so that's why we're suddenly getting a drip, drip, drip of hawkish stories. And I think going into this meeting for the first time in maybe 3 or 4 months, we are more sensitive to a hawkish surprise.
Back to the labour story, and we did get that jobless claims print out of the US, and of course these jobless claims numbers, they come weekly, and it is high frequency data though, so it does tell us something very important. If you're looking for cracks in the labour market, I mean, maybe if you squint you can see them, but it's still a very tight labour market.
Yeah, look, as you say, if you squint, you can see them. I think probably another way of saying this is the cycle is turning. It is valid to say that we're seeing a growth study, we're seeing the cycle turn. It is just turning slowly. We are seeing the jobs market cool, but cool from incredibly hot levels. And so therefore, I think it still has a long way to give back before we've got a panic or a recession in the US economy. And
just a moment to think about some emerging markets, and in particular Mexico, Mark, which I know caught your eye overnight.
Yeah, I mean, unbelievable, shocking. 50 basis points really surprised the market. Not a single economist predicted that. 2 interesting bits about that. One is it ties in with the hawkish theme we're seeing generally overall, but also is at the same time we got the story that Brazil is considering upping its inflation forecast, which would be a duffage message and a real contrast.
OK, remember you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV Go is the place to go if you want to find a markets blog.